Crypto is an incredibly confusing space. There is all of this contradictory data. Countries are selling, companies are buying, the ETF is accumulating, the news say A, the news say B, but what does really matter? I think there's a strong misconception that it's now traditional finance and Wall Street that's making up Bitcoin's price discovery. It's not Wall Street that's driving the prices. Let me show you what really matters. Because yes, the ETFs, the exchange traded funds, do have an impact on Bitcoin. But that impact manifests itself over a very long time period. Here is the number of BTC that's held through the ETFs. And really, this accelerated since January of 2024 because before that we only had the grayscale Bitcoin Trust. Then since November of last year, we've also got an acceleration of purchases through the treasury companies. So Michael Saylor's strategy is the largest of such companies, but in general, those two entities are acquiring quite constantly. When we look at the rate of acquisition since beginning of 2024, that's the numbers we get. 1.62 million Bitcoin had been purchased by the treasury companies and by the ETFs since the beginning of last year. Let's relate this to the circulating supply. That's 19.94 million. So you're looking at 8.1% of the entire supply. Now 2025 isn't yet over. We can say that at least 4% of Bitcoin supply gets purchased every year through those two entities, the ETFs and the treasury companies. And that relates to a mining rate of Bitcoin of roughly 0.8% per annum. So we have acquisition through Wall Street that's 5 times quicker compared to the Bitcoin mining. On top of that, we should of course also expect Bitcoin's price to grow at least with the monetary debasement. This is USM2. It grew by 6.8% per annum over the last 77 years. And that's quite constantly. This is now on a logarithmic scale. It's pretty much a straight line. And so based on those numbers, we can already say that the Bitcoin miners have much less impact than Wall Street. But there is a factor that's even way more important than that. That's actually driving prices. Let's again compare the mining. So that's this dotted line over here with the purchases through the ETFs. And then of course, we've also got the treasury companies, which is roughly the same size. The issuance of Bitcoin doesn't matter that much compared to the purchases of Wall Street. What else could influence prices? Maybe the derivatives market, right? The perpetual futures, the bets on the price. We've got this in this data set as well, the CME open interest change. Now this fluctuates even less than the ETF change. So really, it doesn't have that much of an impact. What really is the main driver in the medium term is the long-term holder supply change. Have a look at this. Now we can barely see the green area anymore. The long-term holders buy and sell very aggressively, and they tend to time the market pretty well, as in they sold into the top when Bitcoin hit 70K. They then bought back when Bitcoin hit around 55K. They sold again when Bitcoin got closer to 100K. Then they bought at around 80 to 90K. And now they are selling since Bitcoin is at 110K. They continue to sell. And that is not a good sign because, again, historically, the long-term holders did time the market quite well. They bought low, they sold high, and currently they are selling, which would indicate the price is rather high right now. Here's the same chart zoomed out a little bit. Again, most selling happens into the rallies and most buying happens at depressed prices. And currently, the long-term holders are taking profit. Now we can argue a little bit with this long-term holder definition because it looks at all of the wallets that have not moved their Bitcoin for the last half year. If we want to look at the very long-term holders, the diamond hands, the whales that have many Bitcoin and that don't move it for several years, that a better metric is the value days destroyed metric. Now, value days destroyed measures for how long has a Bitcoin been dormant. So let's say a wallet has not moved 10 of their Bitcoin, and after 100 days they move it, then they're destroying 1000 value days. In other words, the more Bitcoin somebody owns and the longer they have held it for, the more they can potentially destroy the value days. So when the diamond hands become paper hands, that's when the value days destroyed metric is going high. And this is a good top signal as well. We have not seen that much selling by the diamond hands after hitting 72K in Bitcoin. So Bitcoin went from 16K to 72K, the value days destroyed metric went high. And while we are still seeing long-term holder selling, that long-term holder selling is not caused by the very dormant diamond hands, right? This is not by the long-term holders that hold Bitcoin for 2, 3, 4, 5 years. This is much more medium term because the long-term whales, they sold at 72K. They're probably looking either for another retracement in Bitcoin's price to buy back in and sell into the next rally, or they're looking for a direct new rally, right? When Bitcoin hits maybe 200K or 300K, something that looks like a very accelerated price increase, which we haven't seen since we hit the 72K. The problem is that Bitcoin recently didn't perform according to expectations when we adjust for risk. Now, of course, when all risk on assets go up, Bitcoin goes up as well. But we have to put that performance relative to how risky it is, how volatile the asset is, say, for example, compared to tech stocks. The reason why the comparison to tech stocks makes so much sense is because the price development very much go in the same direction at the same time. There's a lot of correlation here. At the top, we see the Bitcoin price. At the bottom, we see the Nasdaq 100, and those vertical lines, those are simply turnaround points that we can use for comparison. If you're getting value out of this content so far, then feel free to give this a like. You can also subscribe because I publish videos regularly. Of course, any support is very much appreciated. It will help the channel grow. This year was the COVID crash, and this year was a medium-term top in Bitcoin. From that crash to that top, Bitcoin made a 1000% return, while at the same time the Nasdaq 100 appreciated only by 100%. So Bitcoin acted as a levered version on the market. Subsequently, the Nasdaq 100 went up by 26%. Bitcoin didn't do much, so one would expect that Bitcoin should double or maybe appreciate even more than that when tech stocks are going up like this, as happened prior to that rally. But it didn't. And I think one reason for that is the long-term holders that dumped their BTC. Then we had a massive bear market where first Terra Luna collapsed, then FTX went belly up, and so Bitcoin lost 72%. The Nasdaq 100, surprise, surprise, also went down, but only by 32%. So again, Bitcoin acted as a levered version of the Nasdaq 100. It goes up more, it goes down more. And then of course, it one more time appreciates more than the rest. A 500% gain since the bottom at the end of 2022, while the Nasdaq 100 appreciated only by 100%. We can already see how the ratios worsen over time. A doubling of tech stocks led to 1000% performance in Bitcoin in 2020. A doubling in tech stocks in 2023 only led to 500% return in Bitcoin. And recently, the Nasdaq 100 again is slightly appreciating by 20%, while Bitcoin is just going flat. So it seems like the performance of Bitcoin relative to tech stocks is worsening over time, despite all the acquisitions through the ETFs and through the treasury companies. This here at the top is now Bitcoin relative to the Nasdaq 100. So we're looking at direct outperformance. And again, this is the COVID crash. Bitcoin outperformed the Nasdaq 100 very nicely by more than 600%. Or you see at the bottom, that's the Nasdaq 100 in US dollars. So Bitcoin acted as a lever on the Nasdaq up until the beginning of 2021. And something very interesting happened since then. Bitcoin was not able to outperform tech stocks anymore since the beginning of 2021. The Nasdaq 100 still appreciated. It still went up by 100%. Yet Bitcoin didn't do better than the Nasdaq 100, despite seeing potentially much harsher crashes during bearish times. Shouldn't we get this additional downside risk compensated over the long term? Isn't this a sour deal to buy Bitcoin when it just does the exact same return as the Nasdaq 100, when at the same time it's much more volatile? If we can double our money over the course of 4.5 years with tech stocks, and we're just achieving the same kind of performance with Bitcoin, then why do we take all of this additional risk of potentially going down by 70% in the meantime? Or in other words, does this story here actually not even matter that much? The 8% of Bitcoin supply that got purchased through the ETFs and through the treasury companies since the beginning of 2024. Is this maybe much less important than the potential selling by the long-term holders that happens with every rally? Let's have a look at the data again, and now specifically since the beginning of 2024. How did Bitcoin perform relative to tech stocks since we see the acquisition accelerating through the ETFs and through the treasury company? Did Bitcoin actually benefit, relatively speaking? Did we see risk-adjusted outperformance since the beginning of 2024? Here's the beginning of 2024, and this is Bitcoin relative to the Nasdaq. So Bitcoin did outperform the Nasdaq by roughly 60% since Wall Street is acquiring the asset. How did the Nasdaq itself perform since then? It went up, also by roughly 60%. So Bitcoin's price return 2x'd whatever we had via technology stock returns. Let's see what happened with Bitcoin's returns before the ETF acquisitions, when the Nasdaq 100 went just sideways. Did Bitcoin, prior to the acquisitions by Wall Street, underperform technology stocks during a sideways trading period? The answer is yes, it did. The underperformance of Bitcoin was 30%, so this was likely profit-taking by the long-term holders. In other words, the Bitcoin treasury companies and the Bitcoin ETFs tend to buy Bitcoin at a quicker rate than the long-term holders tend to sell. Before we had all of that acquisition, the long-term holders depressed Bitcoin's price relative to technology stocks, and they made Bitcoin a sour deal, as in we wouldn't get enough outperformance relative to the risk, right? It would make more sense to just buy a 2 or 3x levered Nasdaq 100 ETF. But now, since we have the acquisition through the ETFs and through the treasury companies, that acquisition outpaces the selling of the long-term holder. And that creates Bitcoin's outperformance versus technology stocks again. Maybe not in the last few weeks, but in general, over the last 1 to 2 years, this is a true statement. Now, what about the short term though? If we expect that Bitcoin long-term outperforms technology stocks if we are in a somewhat stable market environment, how can we potentially buy Bitcoin when it's comparatively cheap? Again, we can just look at the smart investor, right? The wallets that haven't moved their Bitcoin for at least half a year, because they tend to sell the tops, they tend to buy the bottoms. Currently, they are selling, and this probably causes the underperformance of Bitcoin relative to the Nasdaq. But once they start buying again, when this peaks blue again, then there's a quite high likelihood that we are in a medium-term floor again, and that we can rally from there. Currently, we have selling pressure by the long-term holders, and this is not good. But once this turns into buying pressure, it might make sense to buy the dip. Again, because we've got long-term tailwind that comes from Wall Street, and that does help with outperformance versus the Nasdaq 100. Before we had the acquisition through the ETFs and through the treasury companies, Bitcoin struggled quite a lot versus technology stocks, even during times when tech stocks just went sideways. But the market is very different now. The market is now much more favorable for a long-term BTC investment. Now, most people try to beat the market by reading the news or by following the narrative of the day, but I don't think that that's a good approach long-term. Most people just follow their gut. I think it's better to use statistical data analysis. Try to figure out what kind of rules worked in the past that might continue to work in the future. So you might know about this. I have back-tested moving averages for Bitcoin to try to find out when are we bullish, when are we bearish. It's a trend following strategy. We buy whenever we are above the moving average. We sell whenever we are below the moving average. Now I've back-tested all moving averages from the 2-day all the way to the 200-day. day, and the 125-day simple moving average and the 44-day simple moving average are the ones that historically work the best. That's the two moving averages we see plotted over here. So the 125-day is the line in turquoise, the 44-day is the line in orange. Now have a look at the historical performance versus buying and holding Bitcoin. So we are betting on rising prices whenever we are above. We're betting on falling prices whenever we are below. This is the 125-day. Buying and holding Bitcoin would have given us this performance here in white, but the backtest gave us the performance in turquoise. Here's the same for the 44-day simple moving average. We can see, first of all, that we outperform long term, but also that our volatility is lower, as in the drop from top to bottom is less compared to buying and holding Bitcoin over the same time period. Now, when we've got an approach that tends to perform more and still is less volatile, still drops less compared to just buying and holding Bitcoin, why don't we lever this up? So I tried to find the optimal leverage. If you go long, the best leverage is 2.75. If you go short, the best leverage is just 1x. If you have the same leverage for both directions, long and short, then 2.25 is the best. But in general, I think it's better to have different leverages to go harder on the long than on the short. So this is the 125-day simple moving average if we only go long. We never go short. So whenever we are below the moving average, we're just in cash, we're just going sideways. And here is the short side. So we never bet on rising prices of Bitcoin at all. We are only betting on falling prices. And of course that underperforms buying and holding Bitcoin. But still, it shows us that even though in a long-term appreciating asset, if you can only bet on falling prices, we can still make some return. And so let's say we use the 44-day simple moving average, but we don't just have 1x leverage. So that's that. But instead we lever this up with 2.75 on the long side, with 1x on the short side. This is much better than just going 1x. And again, this is a logarithmic scale, right? So each horizontal line here is at 10x from each other. So that's my preferred medium-term approach for Bitcoin. I just look at where is the price currently relative to those moving averages, and then I position myself in the long or short direction. And because this might be cumbersome, this might be complicated for a few people to always enter and exit those trades, I've also opened up a capital trading pool for the premium members. They can simply just deposit capital and then I will execute that exact strategy and I won't deviate from that strategy. So if history is any indication, we might get performance that looks similar to that over time. At least that's the idea. We don't want to just follow the news or act based on gut feel. We just follow rules that historically worked well. This was a very quick rundown, but there's way more details in the tutorial section of Premium. The link is down below. It's bitcointrader.com. But I'm also sharing my personal view on the market regularly. So every 3 to 4 days, I publish a Premium update video where I share what kind of trades I open, where I share what kind of positions I take. There are more details regarding the strategy in Premium. They're dedicated videos for that. There are also dedicated videos that explain how to actually run the backtest, how to make those backtests yourself, if you want to do this maybe for Ethereum or for any other crypto asset. And so here is the Bitcoin strategy moving average vault. So that's the trading pool. You just deposit some money into that pool and then I will execute those trades automatically for you. So feel free to check it out. It's currently $125 per month. There's also a 1-week money back guarantee. So in case you do not like Premium, just message me within 1 week and I will refund you 100%, no questions asked. A link to Premium pops up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers.